like I discussed earlier as well, that investors should now take a look as to how markets will be impacted tomorrow. And to take this conversation further, we are joined by Feroze Azeez, Joint CEO of Anand Rathi Wealth. Feroze, taking that point ahead, he did mention that this, could impact the macros as a whole. There's inflation, there's fiscal deficit, there's also dollar impact that will take place. How are you reading that, and what should one keep in mind?
Good afternoon, Mahima. Like Pankaj Saab said, that if the impact of oil prices being above $90 or $100 for long periods of time is when there could be a larger impact. But I think the impact is going to be confined to certain sectors which are oil price sensitive, but they have hardly any weightages in Nifty. If you look at the oil and gas sector or the aviation sector, they're not reasonably represented with maybe a couple of % weightages on Nifty or NSE 500. Also, the larger weight of those stocks, a larger weight of that index is pulled by the top stocks, which is not any of these sectors. So point one, of course, any falls due to this kind of escalation, I would say it's a buying opportunity for any investor above 3 years of equity investment as well. Of course, 3 to 6 months could be a place where you would not find large upsides, and there could be selling pressures possible. Now, if you look at some cues from the derivative side, which how we've gone into the market, if you look at the long positions of FIIs, just about 21%. The synthetic futures are quoting at a premium, marginal premium, in fact, lower than the implied 5.5 forward, which they should ideally. The Thursday, next 3rd July expiry was quoting at 7 rupees premium in terms of synthetic futures, and the implied at 5.5 is 25 rupees. That means already there's a lot of bear priced in. That's point two. So I think any knee-jerk reaction should be bought into, and this may not last as long. Because if you look at all, like you were flashing on the graphics, all during war, how has Nifty behaved? Only if you look at one of those wars, which is ongoing, which is from Feb 22, Russia and Ukraine, that has created a dent in only the domestic market of Russia, about 30-odd%. But I think global markets are more resilient to wars lately because they're more threats than actual full-blown wars like in the past.
So any dip in the markets is an opportunity to buy. Feroze, one more question to you. Do you think that because of this, there is chances that there will be flight of safety and investor might shift to something like a gold or US dollars or treasury? What's your reading there?
Yes, see, if you look at already US Treasury is quoting at 4.3 on a 10-year basis, 4.85 on a 30-year basis. US yields are one of the most funniest currently in the form of yield curve. The 3-month paper is 4.3, 2-year and 1 year are at 3.8, 3.7 with $36 trillion of debt and adding $1.2 trillion of debt this year. I personally think people are pricing in a credit default swap at a larger rate for Fed. So I think that coming back to your pointed question, has there been a lot of flight of capital from FIIs out of India to safe havens in the debt market of the US? The answer is yes. And still the yields have not come down there. So point two, I think we've already given away 4 lakh crores to FIIs, 4 trillion rupees in the last almost about 14 months to FIIs. So the frothy money of FII, especially the hedge funds and active traders, have quit India in terms of only 90%. 10% of their money is there. That's my guess. The other FIIs, which are index fund investors and prop institutional investors, have not exited, who are following MSCI and FTSE. So coming back to the second point which I'm trying to make is, I think flight of capital from foreigners standpoint has already happened. Post-COVID, we have added 14 lakh crores. Domestic institutions have added 14 lakh crores in the last 4 years and 2 months. Previous 8 years, they just added 2 lakh crores. So that kind of money is expected in the domestic market.
Feroze, one last question before I let you go. If tensions escalate further, just wanted to get a sense that what is the kind of defensive playbook that you would advise investors to, play right now?
I think the largest weight of Nifty, which is 31%, which is financial services, largely banking, is going to be one of the safest places because RBI has been generous with the rate cut and we've come back to 5.5. There's some more headroom, but I don't know when that will happen. But I think short term, there could be some degree of squeeze in terms of NIMs, but medium term, it's very good. The valuations there are very, very good in terms of they're 1 sigma lower than the mean and the median PEs it has seen for the last 5 years. So I personally think banking is the space, and I think any diversified mutual fund also has large portions of banks because of the inherent nature of it being the core sector. So that's what I would play. I would not play the high beta NBFCs in this space currently, because I think there could be some stress there.
All right, Feroze, thank you so much for taking out the time and speaking with us at NDTV Profit.